Hi everybody, welcome to this crucial video looking at key equations and conditions throughout the entire economics course. These equations and conditions are so useful when it comes to multiple choice questions, when it comes to calculation questions obviously, or just generally to make points in your essay writing. Knowing this is going to be absolutely fantastic, so make sure that you write everything down as I go through it, and also make sure that you practice using these equations and conditions. Let's get started straight away. There are two ways to work out total cost. So total cost is equal to total fixed cost plus total variable cost, but you've also got average cost multiplied by quantity, or average total cost multiplied by quantity there, absolutely fine. Total fixed cost, you can apply the same basic idea. So total fixed cost is total cost minus total variable cost, but it's also average fixed cost multiplied by quantity. The same idea for total variable cost. It's total cost minus total fixed cost, but it's also average variable cost multiplied by quantity. Good to know all of that. Average cost. There are two ways to work out average cost. You can take total cost and divide it by quantity, but you can also say it's average fixed cost plus average variable cost. Good to know both there. You might know this is average total cost and average cost exactly the same thing. What about marginal cost? Marginal cost is always the change. So the change in total cost divided by the change in quantity there. Now we move into average product and marginal product. Remember, these are concepts always when we vary units of labour. So when we look at average product is total product divided by the quantity of labour. Alright, that's very important that you remember it's quantity of labour at the bottom. Marginal product, exactly the same, but changing. So now it's the change in total product divided by the change in the quantity of labour. So how much more output do we get when we increase labour? That's the idea of marginal product there. So important, quantity of labour at the bottom. Total revenue, well, total revenue is just price times quantity, so the price of a good or service multiplied by the number of units sold. Average revenue, well, average revenue is total revenue divided by quantity, but that is equal to price. So if we put total revenue, the equation in here, i.e. P times Q divided by Q, cancel out the Q's and you're left with P. So that's a lovely trick if you have to work out average revenue. It's always equal to the price. Marginal revenue is the change in total revenue divided by the change in quantity. Triangle, guys, just means change, okay? Let's keep going, looking at profit. Profit is different to revenue because it's total revenue minus total cost. Cost comes into it here. Supernormal profit, also known as abnormal profit. This occurs when average revenue is greater than average cost. Yes, it occurs where profit is positive. So using this equation, if you've got positive profit, it means you've got supernormal profit. But it's very useful to know this, where AR is greater than AC. Because when you draw your microeconomics diagrams, your business diagrams, chances are you won't have total revenue and total cost as curves on your diagram. You'll have average revenue and average cost. So at a given production point, if you want to know the level of profit being made, whether it's supernormal or subnormal, you compare average revenue and average cost. If AR is greater than AC, you've got supernormal profit, whereas if AR is less than AC, you've got subnormal profit there. Another name for subnormal profit is an economic loss. Let's look at profit maximization. That clearly occurs where marginal revenue equals marginal cost. That is different from revenue max, which occurs where marginal revenue is equal to 0. And then I've written here AC equals AR. This condition is very important in economics. It tells us four key things. First of all, it tells us normal profit. It's also an objective of firm. So it tells us the sales maximization point. If it's normal profit, it by definition therefore is economic break-even. So it's a break-even point in economics where there is no economic profit or economic loss being made. But it's also the entry limit price. It's also the entry limit price. Okay, so at that point there, the price that is equivalent to that condition is the price that prevents new firms entering the market. It takes away the incentive for firms to enter if only normal profit is being made. Hence, we call it the entry limit price. Let's keep going, guys. Allocative efficiency occurs where demand equals supply, that is, where the marginal social benefit equals the marginal social cost. On a business diagram, that is where price is equal to marginal cost. Very important to know the conditions for allocative efficiency. Productive efficiency occurs at the minimum point on the average cost curve, and that is always where average cost equals marginal cost, so the minimum point of AC. That's where all economies of scale are being fully exploited. What about X efficiency? Well, X efficiency occurs at any point on the average cost curve. So no matter where you're producing, as long as you're on the average cost curve, then you are by definition X efficient. Dynamic efficiency, the condition for this, long run supernormal profit is necessary. So long run supernormal profit, not short run, long run supernormal profit there. The minimum efficient scale occurs at the lowest, so the lowest quantity level when the average cost curve stops decreasing. Okay, so the lowest quantity where the average cost curve stops falling. That is the minimum efficient scale. At that point, it's the first quantity level where all economies of scale have been fully exploited. The average cost curve does not fall anymore. The first point, the first production point that happens, that's the minimum efficient scale. By definition, it's the lowest level of output required to minimize costs. Okay, so that's how you get to the minimum efficient scale, a very important point for a business there. The shutdown condition, well, a firm will consider shutting down when average revenue is equal to average variable cost. At that point, they will consider the idea of shutting down. They will shut down if average revenue is less than average variable cost. So if the revenue being brought in is not enough to cover variable costs, then that is the condition for guaranteed shutdown for a firm. It makes more sense for firms to move their factors of production elsewhere. Average utility, so we move into some slightly different concepts now in micro. Average utility occurs when total utility is divided by quantity. Marginal utility is the change in total utility divided by the change in quantity. Utility maximization occurs when marginal utility is equal to 0. Social cost, very good for externality. Diagrams here to understand that social cost is made up of private costs plus external costs. Okay? So private costs plus external costs. Those external costs can be positive, they can be negative. Social benefit is made up of private benefits plus any external benefits. Okay, and those external benefits can be positive or negative. Okay, so bear that in mind as well. Profit maximization in the labour market occurs where the marginal revenue product is equal to the marginal cost of labour. Let's now look at the 4 elasticities and make sure that you guys know the equations for those. So for PED, it's the percentage change in quantity demanded over the percentage change in price. For PS, I'm going to do this one over here, it's the percentage change in quantity supplied over the percentage change in price. So exactly the same concept, but now quantity supplied instead of quantity demanded. XED, so this is the percentage change in the quantity demanded of good A over the percentage change in the price of good B. And then we've got YED, I'll do that over here as well, that's the percentage change in quantity demand over the percentage change in income. So that's all of those, fantastic stuff. Let's keep going. Let's now look at some macro conditions and equations. Well, to calculate GDP, there are 3 methods. You've got the output method, so the output method, you've got the income method, and you've also got the expenditure method. So there are 3 ways of getting to GDP. The output method is the value of all goods and services produced in an economy in a year, so add up all of that. The income method is to add up all the factor incomes in the economy, so that is interest for capital, that is wages and salaries for labour, that is rent for land, and that is profit for enterprise. And you've also got the expenditure method. The expenditure method is to add up the total amount of spending in the economy in a year. So C plus I plus G plus X minus M, our measure of aggregate demand. So 3 ways of getting to GDP. Now nominal GDP, we get to nominal GDP from any of these 3 methods, that's fine. But the actual equation to work out nominal GDP is you take the quantity of goods and services produced and sold in a year, and you multiply that by current prices. Okay? So the quantity of goods and services produced and sold in a year and multiply by their current prices. That's nominal GDP. Real GDP is very different. There are two ways to work out real GDP. So you take the quantity produced, but you multiply it by constant prices. And that is prices in the base year. So whatever base year there is, you take the quantity produced and sold in a given year and you multiply by the price of those goods and services in the base year. Very useful to know that. But a simplified way to work out real GDP, which you must know, and it's crazy how many students don't know this. Very simple way to work out real GDP is to take nominal GDP and divide by a price index. Any price index will do. So it could be the CPI price index, it could be RPI, it could be the GDP deflator. Any price index, you deflate it, you deflate nominal GDP using that, and you times by 100. That strips out the impact of prices. It takes away the impact of prices. So it's all well and good knowing that real GDP is nominal GDP adjusted for inflation, but what does that mean? How do we actually calculate it? Well, that's the equation. Such an important equation there. Make sure you've written that down. Very useful for multiple choice, very useful for calculations to get this kind of question correct. The GDP deflator, a price index, a measure of the inflation rate of all goods and services in an economy. The equation for that is nominal GDP divided by real GDP multiplied by 100. GNI is just GDP plus net factor income. Very useful if we want to strip out the impact of multinational corporation profits. Very useful if you want to include the impact of remittances. Green GDP is GDP minus environmental costs. Okay, very good to overcome that concern of traditional GDP. Aggregate demand. Aggregate demand is C plus I plus B plus X minus M. You also need to know, guys, not just GDP, but GDP per capita. GDP per capita is just GDP divided by the population. That's a very easy equation for you to write down as well. The multiplier, there are two ways of getting to the multiplier. You've got 1 over 1 minus the MPC, but you've also got, and this is equivalent to that, 1 over the marginal propensity to withdraw. That is the marginal propensity to save plus the marginal propensity to import plus the marginal propensity to tax. So adding up the marginal propensities of all the leakages is another way of looking at it. That will give you exactly the same number as that. That's how we get the value of the multiplier. The unemployment rate, well, to work that out, you take the unemployed, so the total unemployed, that meet the definition of unemployment, divide that by the total size of the labour force. Okay, because the labour force includes those of a working age who are willing and able to work. So basically you take those who are unemployed, those who want a job, searching for a job, willing to work but don't have a job, divided by all of those who are searching for a job, who are willing to work and of a working age. So the unemployed divided by the labour force. Two equations here which are very, very useful. How to work out an index number. So if you want to convert a raw number to index, how do you do that? Well, you take the current value, so the value you're working with, right? So the current value, divide that by the raw value in the base year. So the raw value in the base year. Okay? And then you multiply by 100 there. That's how you convert a raw number into an index number. Very useful to know that. And then percentage change. How do you work out percentage change? What is the difference between two numbers divided by the original number and multiply by 100, and you've got percentage change. Very, very important board of macro equations for you right there. So the last board now, let's look at the Gini coefficient. To work out the Gini coefficient, you take the area between the Lorentz curve and the line of perfect equality, and you divide by the total area beneath the line of perfect equality. Okay, a lot of students will write section A over section A plus B. Now, all well and good, but if you don't have a Lorentz curve drawn, what the heck is section A and what is section A plus B? So very good to know it in words, and then if you've drawn a Lorentz curve, you can highlight these areas by using letters like A and B and C, etc. The Marshall-Lenner condition, right? So this is the condition whereby a weak exchange rate will improve a current account deficit. And that will only occur if the PD of X, so the price elasticity demand of exports, plus the price elasticity of demand for imports, sum to greater than 1. So PD of X plus PD of M must sum to greater than 1 if a currency depreciation is going to improve a country's current account position. The terms of trade, well, to work out the terms of trade, you take the average index price of a basket of exports, so of exports. You divide by the average index price of imports, and then you times by 100 there. That's how you get the terms of trade, which tells you how far a basket of exports can go in terms of revenue when it comes to buying imports there. Taxable income. Now, a few of you need to know these equations, very important. So to work out taxable income, i.e. the amount of income that is eligible for tax, it's simply total income, so the total income earned minus the tax-free allowance, and that will then give you the taxable income in 1 year. The average rate of tax, so basically per pound earned, how much is paid in tax. The average rate of tax, you've got to take the total income tax paid. So the total income tax paid, you would have worked that out, divide that by the total level of income, and multiply by 100. You'll get a percentage, and that tells you out of every pound earned how much is paid in income tax. The marginal rate of tax is exactly the same equation but changing. So now it's the change in total income tax paid divided by the change in total income multiplied by 100, and that will give you the marginal rate of tax, and that tells you for any extra income earned, how much of that extra income is going to be paid in income tax. So of every extra pound earned in extra income, how much will go in tax? That's what the marginal rate of tax tells you. So that's it. That's all the key equations and all the key conditions that you need. Make sure you've written all of that down. Make sure you practice these really well and do past paper questions, and you'll be absolutely banging for multiple choice, for calculation questions. If anytime you want to show off in your essays with these equations and conditions, you'll be 100% right. Go for it, guys. Enjoy. Thank you for watching.